Hello and welcome to Long Investor. So today we're going to take a look at some market data again and see if we are in the middle of a recession that will potentially see more downside to the stock market, or if we are not in a recession yet and we might see a bear market rally or another market upside. So first of all, the S&P 500 ever since it reaches the all-time high in January, it has fallen more than 20%. And technically, this is where the S&P 500 is stepping into the bear market territory or at the beginning of a recession territory. And the sell-off for the past 6 months is caused by the raise of the interest rate, so the Fed funds, and the rise of the Fed funds is caused by the inflation. And the main driver of inflation is the oil price, which has driven up by the Russia-Ukraine conflict. So if we do want to see some sort of a upside for the market, the inflation rate has to come down first. So with that, the Fed may not sound at hawkish on the rate hikes, and when they ease up the rate hike, then that will signal a better market sentiment for the stock market. And speaking of the sentiment, I've talked about this in some of my previous videos, that the market breadth for the nasdaq 100 has already reached a lower point even compared to when we had COVID. And there were only a few times where the market breadth reaches below 10. So we have like 1, 2, 3, and 4 times. This is when the financial crisis, and every single time it is coincide with a market bottom. So from the point of view of just based on the market sentiment, we're at extreme fear, and it is usually a good time to enter the market. And another sentiment that is used for the market is the fixed index. So you see the few spike that we have in the past is usually coincided with some sort of a local bottom. As you can see, in terms of timing, it's not 100% correct. So maybe in here, you see it falls a little bit higher later on. But in the short term, it is coincide with a local bottom, which you see a little bit of rally. Same here, you have a little bit of rally before falling down. So recently, we have the increase of the fix with the falling of the market. And if we were to see some sort of a final market sell-off, we might see the fix go hitting the 50 points area. So as I've mentioned, inflation is one of the main factors that the Fed is sounding hawkish. And in the last CPI data release, I was saying that the core CPI will probably come down. The core CPI is the one that without the food and energy, which it did. And the Fed is usually looking at the core CPI, but the Fed still go with the 75 basis point rate hikes because the oil price seems to be what everybody is concerned about. So first of all, let's take a look at the commodities. So this is the Bloomberg Commodities Index. So ever since at the end of February when the conflict started, the commodities has been rising steadily in the past few months, and I've highlighted the period in June. So in June, it seems to be coming down for a little bit, and it is currently sitting at the level before the conflict started. So the 20% fall of the commodities index will surely ease off some of the inflationary pressure. And same thing with crude oil. Ever since at the end of February, the oil has been spiking up and is steadily increasing for the past few months. And once again, from the June high to now, the oil has dropped more than 20%. So this, once again, will ease off some of the inflation pressure. And if we're looking at raw food, let's say wheat ETF has been coming down since May, and it has fallen about 34%. And the last thing that we'll look at is the 5-year break-even rates and the inflation percent. So you can see inflation has been rising up to 8.5% year to year, and the inflation break-even has been coming down since March. So if the inflation were to catch up to this level right here, it will mark the inflation percent to about 5%. So in terms of inflation, I do believe we will see the inflation rate coming back down in the coming months, although things have been dropping since May and June, but it might have a delayed effect going into the market. So for example, if you're a manufacturer, you have purchased something in June, and by the time you make the product and sell it put it on the shelf, it might be July or August. So there is a bit of a delay between the consumer price versus the raw material price. And the recent market rally really show people are expecting a disinflationary environment, and that the Fed will not sound as hawkish maybe in the September FOMC meetings. But as I mentioned, there might be some delay between the raw material data and when it turns to consumer goods. So if the CPI data releasing next week reaches another all-time high, then we might see the final market sell-off going down, and which we might really see the fix going above the 50 mark. So from the inflation point of view, I do think inflation will come down and it will bring a better market sentiment for investors. And the second thing that we'll look at is the economic data. So a technical recession signals will be a negative GDP for 2 consecutive quarters. So like what we had back in 2020. So we have the first negative growth in Q1 2022, and we will probably have the negative again in the Q2. But this time the negative growth is a little bit different than before. So in order to have a negative growth on GDP, you have to have a decrease on consumer spending. So if nobody is spending money, then the business won't be making money, and the business will have a negative revenue. And in order to save money, they'll have layoffs. So more people will not have money to spend, and it's a very bad cycle. So we do see consumer spending has been dropping ever since March 2021, but it is also well known that it has increased exponentially ever since COVID. And this rapid rise of spending is due to the stimulus checks and people having more savings in the account because of the lockdown. So that is also why we say massive growth or massive earnings throughout the stock between 2020 and 2021. And you can also see where the decrease of spending is also where the government will highlight the recession period. Now, the reason why I said this time is a little bit different is because of the unemployment rate. So if we look at the beginning of here, let's say November 2007 and also January 2020. So in November 2007, the unemployment rate has been spiking up, and you can see the spending came down because of the unemployment rate. And same thing happened here in 2020. You can see there's a spike up of the unemployment rate. However, if you look at the recent slowdown of spending since March 2021, the unemployment rate is not going up. It is actually going down along with the spending. So this decrease of spending is not actually caused by unemployment. And currently our unemployment rate is still very low. And the unemployment data just reached today, we're at 3.6% again. Although some people might argue that since we're at this low level, the only way that this will go is going up. And when it does go up, it will trigger the recession for sure. But this takes time to develop. It doesn't happen right away. So if you look at the past history, when it is at a low level, let's say when this reaches 3.8 on April 2020, and from then until what we call recession, we had about a year. And same thing here, when it reaches to 4.4 in 2006, it takes a bit of time before it climbs up and triggers the recession. So currently we're just at the beginning of the low unemployment rate. The recent fall in spending, I think it's just a healthy correction from the increase of spending in the past year. And if you look at the overall trend line, it is still within the trend. And you notice last year we have the inflation going higher, we have the Omicron coming up, and I think those have been putting the consumer in a very cautious state as they will save their money and they don't know how strong Omicron or how bad Omicron is. And of course, recently we have the gas price going higher, so people are not really willing to spend money at the moment. But if gas prices are coming down as I was expecting, I do believe the consumer spending will stabilize. And also earnings season is coming up. On the last earnings season, a lot of companies are expecting a slowdown in growth. And slowdown in growth or slowdown in revenue is still better than negative revenue. So if we see a negative revenue on the next earnings seasons, then it will be a very bad signal to the market. But if we're just seeing a slowdown in growth and as long as they're still making money, then I don't think we will see a recession just yet. Now, with all that said, there are always risks that will trigger off a downside to the stock market. As I've mentioned, the delay of inflation data from the raw material to the actual data, or if Russia escalate any of conflicts, you know how they recently said they will take back Alaska, or suddenly if China decide to take Taiwan, all those are risks that might trigger the more market sell-off. But in the meantime, based on the price falling in commodities, food, and energy, I do see some sort of a relief in the inflation numbers. And perhaps we might be very close to the bottom. And at this stage, we might be entering a technical recession, but I don't think we're in a true recession just yet. So this is all I wanted to share today. If you liked the video, do subscribe to my channel and give me a thumbs up, and I'll see you guys next time.